Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their career. In this episode, we will be learning from Crispin Leick, Managing Director at EnBW New Ventures GmbH. Crispin, welcome.
Hi, Nicolas. Thank you for the invitation and great to be here. So greetings from windy and rainy Germany, where I think today renewables will make up close to 100% of the whole electricity production.
Your mothership is all about wind. I know that. So I'm sure we will go into that afterwards. Crispin, I always like to start asking your journey into corporate venturing.
So that's a question where I can probably talk an hour about, but let me just try to get the biggest points ready here. So first of all, I decided to go into or to study chemical engineering. But chemical engineering is a broad topic, so it was focused on energy technologies. And I was fascinated basically by the question of how to generate sustainable energy from the very beginning. And that sort of drove me into chemical engineering. And there I had to learn, of course, first, what is the existing technology? Because at the time, this was in the early 90s, renewables only played a very small role. So I had one course only about renewables. All the rest was gas, oil, coal, and all these things. So that was the first piece, basically closing or being a chemical engineer. Then there are in my career, like the last 26 years, there are three major pieces. And the first piece I would qualify with portfolio management. So after studying, I thought, okay, it's maybe not yet time for the renewables. So what do you do? And I decided to go into the natural gas business because I thought that could be the bridge. And so there I actually went into the unit that was handling all the large contracts, import, supply, storage for Germany. And also later on, I was then changing to an American company doing power trading called Enron. The older people know the company pretty well, not only for the good things. I learned incredibly many things. It was a very dynamic and innovative 7 years in a row, the most innovative company in the world. And then chapter 11. So that taught me also a lesson very early. Just being innovative is not enough.
Well, actually, yes, maybe it was too innovative on the accounting part, right?
That's the point. Maybe you should focus your innovation on bringing value to your customers and not so much on optimizing your own books or something like this, or building very complex structures. But still, it was a crazy time and many of people, like you can imagine, there were like 20,000 people in Enron and then it went chapter 11. So these 20,000 went everywhere. So first piece. Second piece, then ultimately the renewable. So I went to a wind turbine property developer and manufacturer. There basically I exchanged the good salary that I have before in the trading world and in the energy world to having a lot of responsibility. So I was responsible for the European expansion of a still small company at the time, developing wind projects and also having their own wind turbine technology. This business was growing and growing. So at the early times, 2002, I actually entered there. The renewables had in Germany, 3-4% market share, so still very small. And I changed and went to the largest German power generator, RWE at the time, known for a lot of coal and dirty stuff, but they were putting all their renewables into one unit. So wind, biomass, hydro, and PV was basically inexistent at the time. And I was lucky to join there and to support a little bit in getting this off the ground. And this was also then the point where actually the impulse came for the venture capital world. So the third piece in my career is 16 years of corporate venture capital now. And that started 2007 when actually the managing director of RWE Energy at the time basically asked me if I would have an idea. They would love to push innovation in the renewable space, but commercial. It's not so much R&D or technology driven, but more really on the execution side, on making money with it and scaling it. So on the one hand, I've worked for a very large corporation. I've worked for a small, very strongly growing corporation. I had a sort of drive for the renewables. And then I had this large corporation that wants to invest into this. So the idea was not so far away to actually propose what you need is a corporate venture capital unit. And what then happened is sometimes in large corporations, if you propose something and they like it, then the answer is, please, you proposed it, now do it. Yeah? And of course, I had no clue at the time. And so I reached out to some US-based VCs because I just didn't know how to do it. And I had this idea and I thought, okay, I have also a clear plan and an investment strategy. And then these US VCs, they talked to me and they gave me a couple of hints. And I should have listened better, actually, because at the time I still thought that I can do something a little bit different and not learn from them. So as they told me at the time, you will need to burn through a couple of things before you really know how it works. And this is what I did. And so the first fund, EnBW Venture Capital, was not a failure, but there were still a couple of things. We had 5 insolvencies, for example, and that's really tough. You need to get through this. We had also 6 trade sales and 1 very small IPO, but still. So I learned it the hard way. And and then the final step, of course, the EnBW New Ventures. This is when the chief innovation officer actually reached out to me and said, hey, what you've done in EnBW Venture Capital is cool. We have all the internal innovation tools, but we are missing the external investment arm. And and this is when I then had the chance to meet with the board members of EnBW to actually learn and understand what they're thinking about venture capital, to propose how I would envision to build it. And this was a great fit. And since I have a lot of fun and hopefully also a little bit of success in building EnBW New Ventures.
Very nice. So I would be asking what you learned from the first CVC to the second CVC. But before that, from your background, I want to understand your chemical engineering background. How much of that experience on previous career, first part, is helping you today both to identify the right entrepreneurs, but also the right project?
Yeah, I think there are many different ways into CVC or into VC generally, but your own experience plays a role. So bringing sort of sector expertise in the energy world, having lived through this strain and knowing about this strain, I think is quite important when you talk to entrepreneurial teams, because it's just amazing what these teams are doing, and their commitment and the risk that they are taking. And I think this needs to be acknowledged. And when you have lived through pieces of this on your own, I think it helps. But I'm also, I said before, there are different types of investors. I'm a portfolio manager. This is completely different from some investors in our community that really say we are entrepreneurs on our own, which is a value proposition, but it's a different one from the one that we are bringing. So we can bring experience out of all the deals and, of course, getting consortia together and so on. We can bring sector expertise. We can open doors to EnBW, to even more experts on certain matters. But we would never claim we are also entrepreneurs. The decision stays with the founder team. And it should be also there because after all, we're just an investor and trying to facilitate and help to increase the probability of their success. That's all of it.
Actually, I want to touch on that. Indeed, we are minority investors. We are not majority investors, but there is a temptation, especially when an investor knows a business well, to feel like they can influence the strategy of a startup they invest in. How do you feel about that temptation, and how do you make sure that you stay that disciplined investor versus the one that wants to drive everything?
We are still an active investor. We like also to take board seats if that is possible. Not a must, but we are happy to do so. We also lead or do co, but we also lead. Some CVCs never lead, but we do that. But it is more thesis driven. So basically what we do is when we talk to the internal teams, okay, what's your vision? Where do you want to be? And then in 3, 4, 5 years, and we don't take the exact numbers, but it's more, okay, do we share that vision? Do we think that this could really work? And then we really discuss, okay, what is there now? Which logos do you have? What is your growth rate? And so on. So we're looking detailed. We're not very completely hands-off, but they steer it. My own experience in having a corporate VC taking the too large share Above 20%, it starts to get dangerous. Above 25, it's an absolute no-go, because then it starts to transform into something which is more like a type of a subsidiary, which is absolutely not what we want. We're a VC investor, so the team is driving the growth and we are financially driven. We understand the thesis and we have a frame in our investment strategy, but we are a growth investor at the end of the day and financially driven. So I always tell the founder, it depends on what you are looking for. So being financially driven is very nice as long as you deliver. If you don't deliver, and not your best friends, we need to make money. You want to make money. We want that your startup succeeds. That's our only focus. Yeah, there's not a strategy thing for EnBW that we're trying to deliver with your startup. We see potential in what you do to do more with EnBW and so on, but that's your decision. That's the decision of the operational units. But at the end of the day, we give you money. You need to deliver on this.
So it's good. You learn from mistakes and the value of not taking control. So part of what you say, which is, I think is implicit, is that you never invest with a commitment or an obligation for the startup to work with EnBW. And maybe you can speak to why this is the case, because I know it's a best practice, but I think it's good you explain why you think that's the case.
So first, I think what I mentioned before, when EnBW was contacting me, if I would be ready to build EnBW New Ventures, it's very important to talk to not only one board members. The best is to talk to all the board members and understand what do they expect from this tool. And do they expect the same thing? There were different messages, but the overall message was fitting to the business model that I'm believing in. So the real situation is that there are many corporate innovation tools. So there's incubation, there's venture acceleration, how some people call it. And there is venture capital. And I think units, whenever I talk to others heading CVCs, when you put too much of the general innovation strategy and sort of cultural change things into the CVC, then it gets a multitask and it's very difficult to deliver. In our case, the whole piece of incubation, acceleration, strategically building internal teams, like corporate project, all this, and dealing with the innovation strategy, all this was already there. And our task was really investing into external startups. So a pure, sharp CVC approach. And I would always advise in the beginning of a CVC, it's really important to understand what's the basic motivation of the corporate. And I would say there are two classes. One class is the corporate that is the business is running so well that they have so much cash right now that they think, let's get innovative. And then there's the other one in a very difficult situation. Core business model under attack by new entrants, by innovational change, by new technologies going into the market, being really under the pressure and asking yourself, okay, we need to change something, but how? And this is second class. And my first CVC was the first class, and my second CVC was the second class. And I would really advise it's easier to start a CVC with the second class because there's not an innovation theater, but it's a real need. And there's also the patience and there's pressure in the business for innovative solutions, while the other one is more, yeah, we're nice and sexy. And this pressure, not by own wrongdoing, but by changes in the corporate, is, I think, in the first class much bigger than in the second class. So these are the reasons why I'm responsible for the CVC business model. I need to make money, and this is what I need to deliver. The operations are responsible for their business. It's not on me to tell them what works better or not, but I have to find things that are just so convincing and great products. And I know their pain points because I'm part of the family, that then there is a certain probability that it actually works out.
Yeah. I've never experienced a sustainable partnership where you force people to partner. So I think the way you describe it is you create a context where the partnership can happen, but you want both parties to want that partnership.
Exactly. And this is hard work. And Nicolas, we spoke a little bit more than 2 years ago. We spoke about TDK Ventures and about EnBW New Ventures, the setups. And at the time, we touched exactly on this point. And I asked you, how have you solved it? And you were explaining to me engagement management and how it works. And actually, I took this really as an advice, and we started being much more active there and have our own engagement management now. So this was really a very important hint from your end.
Oh, wow.
Yeah.
I didn't know that. Thank you. I think the engagement team wake up every morning excited by the potential to create partnerships. And the way we look at it is we call it equal win engagement. And what that means is most people talk about win, but typically it's a small win and a big win. Guess what? 2 years later, whoever gets a small win will leave, and whoever thought they had a big win have nothing. And so you really want to have these equal win engagements where both sides really want to work. They identify real value to create together, and then it's going to be sustainable for a long time. And if you think about the true value of a CVC when you create partnership, is this kind of partnership that becomes really valuable over time, where the startup becomes this unicorn and this major market player. And then you really have crystallized maximum strategic value on top of financial value. I think it's not a tip, but maybe it is a tip. I know that I've recruited the right person for the engagement team when I can see how excited they are to work with TDK, and they discover solutions inside TDK and they're like, wait, this could be useful for this portfolio company. And they love to connect the dots. And so I think that when you recruit people who are curious, passionate about the topic, and they love to connect the dots to create value, I think that's really a good sign for the engagement team. So I want to go back to the fact you had done one CVC, probably learned a ton, and then you offered to start a CVC. So you really have a chance, not just to talk to the board of directors, make sure you have a good alignment, but design it the way you think it should be done. And so if you could share maybe one thing that you learned that you for sure wanted to do in the next one, and something you knew you would not do again.
There's not only one thing, but yeah, I think there's one thing. I'm a big fan of setting up a CVC as close as possible to the traditional classic VC model. Yeah? But then there are a couple of things that I think a CVC should do different. And one very big point is we're set up as an evergreen. My first CVC was a traditional closed-end 10+2 closed-end fund. And what I've learned there is that this traditional thing of you have this investment period, so you need to invest very fast and get all these portfolio companies in. And then you have your divestment period that the whole market knows you need to sell sooner or later. In my first fund, I thought it's important to have this because I thought this puts this natural pressure on exits. Yeah. And I was fearing a little bit that the corporate could this sort of hang around things. And I thought a closed-end fund is good because then we're forced to sell. This we changed. We're an evergreen. So that was one big change that we did. And that up to today, I would say it was a real valuable change. So it was a good decision. Then another thing is with portfolio management, where in my first fund, I was not so strict. And if you get overexposed on one portfolio company cash-wise, you have to absolutely avoid this.
And that leads very nicely to evergreen, because I find the evergreen concept to be, on one hand, so simple to understand, but so difficult to operate, including on the pace of investment. So do you mind first sharing with the audience what is an evergreen and how did you set it up?
Yeah. So the very first definition of the evergreen is very simple. It basically just means it runs forever. He's for evergreen. And so there is no time limit on the fund or on the legal entity that you're operating. That's the first thing, but it doesn't end there. The second very important piece is that I call it always, it's a closed business model in itself. Why? Because basically you go to the corporate and they allocate and commit a capital, for example, 100 million in our case. And what I then did and told the board of EnBW, thank you for this commitment. we are an evergreen setup, so you will never see me again asking for more money. Why? Because you have this capital commitment, and after year number 3, 4, 5, you come also with the exits. And now comes the magic. When you have the exit, assume you have invested 10 million and you sell it for 20 million. You then afterwards have 10 million more. So you're not a 100 million fund anymore, but a 110 million fund. And that's the big advantage, because you can basically fuel your own growth as a fund and your next fund out of the exits of your first fund setup. And for the C-level, I'm not only telling we will make returns, but actually we depend on, as a whole unit, on the cash on cash that we're delivering, because otherwise we cannot invest. And my whole team knows if we're not delivering, then we shrink. So if I lose the 10 million, then I'm only a 90 million fund. So it works in both directions. And I think this is the beauty of it. It's for us, it's also accountability. It's not hoping to go against, because we are a single LP fund. Other corporate VCs try to take this risk a little bit by having a multi-LP fund. I think multi-LP it's a challenge, because they probably have different interests. And so you deal not only with one corporate organization, but with 2 or 3 or 4. But at the end of the day, having this closed loop. And then there's one difficulty that comes with it that you need to solve. And that is, how do you measure performance? And there, of course, the answer is, you don't need to reinvent anything new, but you really need to just apply the traditional metrics of a closed-end fund onto your evergreen, and you build cores.
No, that I think is quite straightforward. I think one of the biggest challenge I see, especially in 2022, 2023, you don't have so many exits. And if you didn't expect that, you may end up with very little you can invest right now, when actually this is probably one of the best moments to invest in startups at the right valuation. So how do you pace yourself to make sure that you take that into account?
Yeah. I would even argue a little bit the other way around, that when you know that you have a limited capital and you will not fundraise into the next fund, that you work with this capital in a much more controlled way, that you're really looking on, okay, so we always look into the next 2-3 years and have to ensure that we have enough capital for all the portfolio companies available. That's what we have to do. So, because there can be always 1 or 2 years where exits are not possible. On the other hand, the good thing with the evergreen is that it's only value driven. So my corporate doesn't expect from me that this capital is all invested. So I can pull the trigger value driven and not time driven. But on the exit side, we follow the timing. So when we saw these incredible valuations, 21 and 22, we just sold some of the companies. We didn't think that we would sell early, but the price was right. So we just sold. And this is why we're happy to have a couple of successful exits. And then after such a booming period, if you're used with the exits, then comes maybe a much more difficult period. But logically, you have some of these exits already under your belt. So yes, a little bit of luckiness is there.
No, I think it's a golden nugget. Now, let's talk about who is in your investment committee.
So we are a GmbH, which is a legal liability company. And I'm the managing director. The investment team submits deals to the investment committee. So the investment committee is not telling us, here's a deal, you have to do it or so, but it's really coming out of the team. But for every transaction, we need support of the investment committee. We have 5 members, and there's 3 from the corporate right now, and 2 are external. So we have one, basically an investor slot, which is an ex-early bird partner in our investment committee. And the other one is an entrepreneur's slot, who is an entrepreneur who is actually also an ex-consultant partner, knowing utilities very well, but has built his own digital company. And the other one is the international investor experience. And the 3 EnBW members are not responsible for business units. They are responsible for overall transformation in EnBW. They are responsible for the transactional business, finance and M&A, and they have a legal background. So this is the setup. It's not exactly like a VC, but we need VP levels because they must have decision power and experience and standing, but they should still be excited about this and having the time to react fast, because we have quarterly meetings, we have monthly updates, we have so-called Umlautbeschlüsse, so that at any time we can basically drive a decision and get a decision within 2 days or so.
Wow, this is fast. So this is very interesting. I think it's the first time I hear about an IC of 5, where the 3 are corporate but not attached to business group, and 2 external with investment and entrepreneurs mix. I think it's very interesting. Thank you so much for sharing with us all your journey, the tips, the best practices, what you learned from the first CVC into the second CVC. Thank you so much, Crispin.
Thank you, Nicola. Pleasure and fun, and I'm sure we'll meet again.